Howdy, Jacob here. Today we'll be going over company number 3 on our dividend yield screener. And today our company is American Electric Power Company. They are an electric utilities company. So it's a type of company that will likely have monopolies in certain areas. So just some quick looks here. We can see 40 billion market cap, 76 billion enterprise value. So a lot of net debt there. Revenue as expected. One sees super big growth, 14 billion to 19.6 billion. Pretty low return on invested capital. That's pretty common for electric utilities business. ROE looks good, pretty much, or looks all right, probably just because they have a lot of debt. Let's see what they're looking at. Ooh, increased debt pretty heavily from 15.6 to 33.6 billion in roughly 11 years. Pretty consistent cash flows though. Let's see, 5.1 recently, probably averaging maybe 4 billion. Consistently higher than net income. That's good. Not from, I don't see share compensation here. It looks like pretty heavy depreciation and amortization. Makes sense if they're creating the electrical systems in all these areas. All right. So let's see. We got 3.52 for their yield at 4.6%. Interesting graph, yeah. Probably won't increase. Probably not the sexiest company, but all right, let's see. So revenue growth is probably, I don't see it going anywhere. Maybe 3%, probably similar to inflation. I usually go 13 on PE, but just from the monopolistic view, just like I feel like most of these utility companies are pretty monopolistic. I might let's put 16 on there. Discount rate 15%, margins maybe 12. And whoa, that's so much higher. Interesting. Let's try 12 and 25. Share change increase about 1%. I mean, let's see where their shares been going. They've been going up pretty lightly until recently. They've been increasing their common stock. They had 2 acquisitions. That's probably why their growth was bigger over here. I might lower growth over here 2%. For dividend yield increases, I mean, we're looking at about 4 billion here. They're issuing dividends about 1.7, so less than 50% of cash flow. But that is a lot of net income. That's fine. You use cash flow to pay dividends. So let's say 4% a year. That seems to be 4, 5, 5, 7, 6, 5, 5. Let's do 4 pretty conservatively. And we're getting prices that are wildly different just because their earnings and free cash flow are so different. But let's see, have a roughly $52 buy price to get 15% return given these assumptions. And that's currently $77. I mean, on a free cash flow basis, it looks fine, but I feel like if we were to look at the historical price to free cash flow, it's probably quite a bit lower in 16. But we can look at that when it gets closer to the price we want to buy it at, since right now it's looking like it'll have to fall roughly 33%. Okay, well, thank you everyone. I hope you have a good rest of your day.